So it's the panel discussion. Topic is this the twilight of the junior? Let's welcome back John, who's going to facilitate the panel discussion.
If you're ever looking at the health of the industry, this is fantastic data. It's the TSX Mining and Metals Venture data, okay? So you'll see there, this is the last 10 years, and what you'll see is you get these steep, so the white is venture and the blue is mining, okay? So you see mining's much flatter, but you see the venture index, which is the explorers, the junior explorers, it ramps, gets really, there'll be some sort of excitement over about 2 months and then it slowly comes down. Then it ramps and it comes down. And this is where we are now. So it's actually in a pretty healthy zone. It's up around the 50. It was with the venture, it's in the 50s, right? So if you look at mining, it's just a pretty steady increase. It doesn't have these huge fluctuations, but you can see exploration, it's boom and bust. So if anyone who was in the industry in 2016, you'll know it was not a great place to be, okay? Same, there's a little COVID blip. And if we expand that data out, you can see over the last 30 years, so this is expenditure in Australia, and you can see WA kills it by a mile. And you can really start to see the expenditure dips. And you can see it's really cyclical. There's a real sinusoidal curve there, right? So what we know, it's a really cyclical industry. We all remember the busts. I mean, who here was working in McDonald's in 2002? I'm sure there would have been one or two of us, absolutely. I know Jim Richards, for example. Jim, what were you doing in 2000, buddy?
I was on an oil rig in Pakistan. It's about just after 9/11. It's the only job I could get, mate.
But didn't you work at Bunnings for a while?
Oh yeah, I was counting. I was doing the GST audit in Bunnings as well. $8 an hour, mate.
So we've all been there. We know it's a cyclical industry. So if things are even going bad now, if we think, it's really, things are tough out there, we've seen it before. It doesn't mean that there's some real structural problem with the junior market. It's just a fluctuation. So if we look at, this is expenditure in Australia via the different commodities, and you can see it all goes up and down. Iron ore, obviously, it was a big part of the 2010, 2011 boom. That's dropped off, but gold has been pretty constant. So there's always been a good amount of gold out there. It's a big part of what we do. You can see in the last 3 years, it's probably sort of 60, 70% of exploration expenditure. So gold's a really good indicator of what's going on. We see the gold price. We all know where it's at. It's doing amazingly since 2020, 21. We know the gold price. I should have put a graph in, but it didn't. It correlates to 0.90% correlation, which is a massive correlation to US debt. So if you've got a US debt chart, it just follows it pretty much. So, which is really interesting. We know US debt's not going anywhere. So we know the expectation is gold's going to stay around those prices for quite some time. But what we're also seeing in the market is this is the amount of IPOs. Okay, so from 2017, you see 2021, great year, 200 IPOs, and I think there's been one in 2025. So what's going on? So that's the question. Is this structurally something completely different to what we're used to? Or is this just another blip in the cycle? Okay, so today, and that really does beg the question, is this the twilight of the junior? Is that what this is pointing to? Is there some structural feature in the whole junior exploration industry that's totally ruined now, that's beyond repair? So that's what we're going to explore today. To help us do that, we've got a panel of experts. To start off, we've got Mike Brown. Mike's been a CEO geologist with 30 plus years experience in multiple jurisdictions, LATAM, North America, Indonesia, West Africa, Saudi Arabia and Australia. He gets around. He's a previous CEO of ASX, TSX companies, led the discovery of Diamba Sud, 750k gold project in Senegal. Please welcome Mike. Next in the row, we have Jim Richards. Jim is Executive Chairman of ASX-listed Gibb River Diamonds. He's a Perth-based geologist and has been involved in the discovery and development of a number of major resource projects in both mining and petroleum industries. This includes the Amai gold deposit in Guyana, which became at the time the biggest gold mine in South America, and the Railway iron ore deposit in Western Australia, which was acquired by BHP in 2010 for $204 million. Please welcome Jim.
Thank you.
Next, we have Andy Eddowes. Andy is a geologist with over 25 years' experience in the exploration and mining industry. He's worked on major projects within Australia and internationally. Andrew has experience from junior to ASX 100 companies across exploration, resource development, M&A, investor relations, and public markets. Please welcome Andy Eddowes. Sue, who you already know. Sue is a management consultant, geology at Snowden Optiro, leading their team of Australian-based geologists with over 2 decades of hands-on experience spanning exploration, mine and resource geology and consulting in Australia and internationally. Please welcome Sue. And last but not least, our resident lawyer, Pete Bramall. Pete spent 20 of his 30 years working as a mine tenement manager. Pete is our resident mine compliance expert. He began his career as a field technician on a drill rig in Orange, drilling the first holes into Cadia. Next, he became a tenement manager and studied to become a lawyer. Please welcome Pete. So to get this started, I've got some questions. The format will be a few questions, a bit of data, and then we'll go to the panel. So the first question is, the funding crunch and capital strategies, are the traditional financing models for juniors broken? So if we look at the data, this come from Rob this morning, there's still a hell of a lot of juniors on the market. There's over 700, right? And if you look at how many there've been over the last 10, 20 years, you see there's always about, 700s, 650s low. We're up around, the 800s in peak times. And then if you look at the number of companies by exploration expenditure, you can see there's a fair few. Like if you have a look around, anything below those first 4 columns, the 50 to 100,000 mark, there's zombie companies basically. So if you're spending less than 100K a quarter, you're a zombie company. You're not putting anything in the ground basically. You're blowing 400K a year probably on admin. So that's about 20, 30% of juniors at the moment are in that zombie sort of stage. So the question I've got, so we'll start off with Andy. So Andy, you've worked in the industry a while. Is this just another boom bust cycle, or of all the structure issues, is there some serious structural issues with the model at the moment? Are these zombie companies, these lifestyle companies, are they having a real impact on market confidence and what's going on?
Well, as you mentioned, John, like the industry is very cyclical. I think that cyclicity at the moment is just getting volumetrically sort of exacerbated by geopolitics. The last sort of 10 months have been unprecedented in sort of the junior end of the capital markets. Not only, it goes beyond having a good project. If you've got a good project and you can communicate it at the junior end of the market, you will get funding from it. There's always a base load of funding for junior resources that gets topped up by investors with risk appetite. To me, investors have a bucket of tolerance that they can take, and that bucket's overflowing at the moment with all the geopolitics, Trump, wars around the world. We've had a federal election here. One of the things that may come out of that is, changes to taxation on superannuation, etc. At the real junior end of town, we often rely on those people with that plus $3 million of superannuation to be the risk-on investors in junior startup companies and IPOs, etc. If they feel uncertain about what's going on in the world, they're going to keep their their powder dry until they feel comfortable to execute on that. So I don't know whether it's fully broken. the model yet, but it certainly is challenged. There's no doubt about that.
Gotcha. And do you see, is there any other way we could help, the way the current funding, just ASX, public listed, do you think in the current environment there's better models to go towards?
There's definitely a growing trend towards private equity investing in resource projects, that's for sure.
Yeah.
But if you want some serious capital, depending on your network and your expertise, you may have to go public at some point.
Yep. Gotcha. Cool. And in terms of that private equity, is that easy to access? Is it as easy to access as floating a company used to be?
It's easy as access. No, I think they've both got their own unique circumstances and challenges. Certainly with private equity, whilst they offer funding, they certainly want their pound of flesh when they take it and give you that funding. And, you've got to get in bed with the right sort of people if you want your project to move forward.
So they ask you for higher percentages in a public market generally? Yep. Gotcha.
Sure.
And how do you, is it just a network to tap these people? Is that?
It's a network. It's demonstrating your capability, your integrity, what you've done in the past, all that sort of stuff comes into the equation.
Yep.
Yeah.
Gotcha. Cool.
I think building on that structural comparison, it's interesting looking at TSX North American markets versus Australia. Australia hasn't had the same competition for speculative money that North American markets had. They had marijuana stocks, then they had Bitcoin, and there's been a real shift out of risk-on money in the markets in North America in the past 5 years at least, and then sort of it's a defendable position. When you look at Nvidia, you can get 400% returns on a multi-billion-dollar stock. The question is why invest in mining stocks when we've got and this is the points we're going to come to them soon, but when you have really got a lack of exploration discoveries to show 10 baggers, 20 baggers, 50 baggers, 100 baggers, whatever, and why we're here. It's interesting that most of us are geos. We're sort of, we filled in the wrong boxes when we signed up for our university course.
Speak for yourself, Brownie.
But when you look at that structural thing, Canada in particular has a TSXV, TSX, certainly on the exploration side, there really hasn't been money in that for the last 5 years. Australia, in difference to it, there has been a flow still in for money. In Canada, it's been rotation out of certain stocks with good projects from a breadth of stocks into just a few companies that have projects. Here, I still think there's a bit of a heartbeat, and that's probably different. And one element that I don't think we've really seen in Australia yet is the royalty and streaming companies, which really in North America have kept that market alive, albeit that's for mid-stage, advanced stage development projects, and it's not for juniors. So is the junior model broken? I don't know. How do we get money into exploration? All great topics that I think we're going to cover in the talk. But there's certainly, if you look at what's happening in North America, there is a bit of a defrost happening. There is money coming out again, but nothing that really has been low compared to what's been going on in Australia, ignoring IPOs and that sort of type.
Wasn't like Canada, what I was hearing, like there's a total lack of mining confidence because there was a report, and I think the average time to get a mine up was 20 years. And so everyone I think it was the head of BHP said, we've just fallen out of love with Canada. And is that why a lot of that Canadian money is coming over? The people are coming over here. Is that sentiment ruining the investment?
I don't think it's necessarily the time to market because the biggest gain is the exploration discovery. And then there's a death of valley.
Valley of death, yep.
And then you go from, I've gone to FID or construction to operation, and there's another re-rate. I think that first 10-time, 20-time lift, there just haven't been enough inflow in to keep Gen X's, Gen Z's, Gen Y's, Gen whoever's in the market, and then the money that flows through and into them. So
Yep.
that's been an issue.
And as you mentioned, like I remember in the 90s, like exploration, that was the speculative place to be. But now there's just so many vehicles where you can put your money, like crypto. Like every kid knows about crypto, right? But no one knows about exploration speculation. Mm-hmm. Jim, you've been in the industry a while. You've 2010, you went through this whole raising money. Have you seen it change? How's the finance side of it changed?
So, thanks, John. So to get a feel for the changes that have gone on in it, if I can maybe quote John Howard, I think that's the wrong question actually, but you know, everybody's looking at, well, why has it changed? How has it changed? Is it the money raising that's changed? Is it land access, land tenure, Aboriginal heritage? Is it the trying to raise capital in the various different ways you change it? Is it overseas competition from Africa? I mean, there are a myriad of different things that change the industry as we go along. But to perhaps bring a different perspective to it, if you look at the timeline on a different scale, it might give some perspective as to where we now are. So if you look back historically, we won't take it right the way back to, Agricola, but we'll maybe take it back to the start of gold mining in Western Australia, for instance, to give us a paradigm to work off. So in the 1890s, the prospectors are going out. The first guys out there were speccing gold, just picking up nuggets or picking up bits of reef gold, and the glittering, glamorous stories that followed from that. And then from there, Claude Debonales came along, and other historical figures came along, and the mining gradually scaled up into 1900s, 1910s, and throughout their own problems that they had with land access, the enormous problems in the 1930s when the Great Depression was there caused them similar land access problems, and particularly when the First World War and the Second World War came along, the mines were decimated by lack of labour. Debonales' mines were knocked out through nationalisation in the First World War. In the Second World War, his mines were nationalised. So these kind of boom-bust nightmares that we've been going through, there's nothing new about them. Obviously, I think we all appreciate they've been around a long, long time. But the one part of that narrative arc that I've been talking about that doesn't change is that the scale and the size of those gold mines has constantly gotten bigger over time. It used to be the guys speccing. Well, there are still guys, admittedly, metal detecting, but the guys speccing were consequential back in their day. Now, the only consequential mines are the ones that have gotten bigger and bigger and bigger. And back when us guys met back in the mid 90s for working for Resolute, if you were finding a couple of 100,000 ounces, you could develop that. Now you can't. Pretty much you need 500,000. You go and see the brokers, they're asking you, where's the 1,000,000 ounces? Jim, they're not even asking about the grade, half of them, but the scale of those gold mines has constantly gotten bigger. And what has happened is that sooner or later, the scale of the gold mines that you need to make the economics and all of those land access, tenure, particularly productivity issues that we've been talking about, that you need to pull in to make those gold mines work, diverges from the geology of what you can actually find or produce. And we're at that changing point now, during which those two lines diverge. And that is why, personally, I think this is a fundamental change in the outlook of not only gold, but the same thing applies to copper and other things. I just use gold for an example. And I think there are dark days ahead because the geology can no longer catch up with the lack of productivity, lack of land access, lack of everything else. And it's wonderful. There's a great talk from the Geological Survey, EIS and all of that stuff, but I didn't see the slide on land access or how you're going to finance the increasing mining rents that indeed are going in to pay for the EIS, I might add. So you're taxing the explorers to pay for the producers to put holes in. It doesn't make sense. And so many of the government policies don't make sense. You're paying for Aboriginal surveys. You can only deduct 20% of that on your allowable deductions for the year. That goes back 20 years, that rule. It's just nuts, because the biggest challenge of any of us is particularly Aboriginal heritage land access, which you've got to spend a lot of money on. So government is one of those problems as well, because they have definitely not kept up with it. And so I fear that there are dark days ahead, and that is why the producers in Africa, and you can see how they've knocked out lithium, because to produce a ton of lithium spod con at 6% in Africa is one a hell of a lot cheaper than it is to produce it here. And that's why the lithium guys are stuffed.
Cool. So that's a great segue into the next question, and it's about declining discovery rates and exploration effectiveness. Okay. So if I have a look at this slide here, so that's the declining discovery rates of gold. So if you have a look at, that's the gold resource, the amount of resource in gold, basically. So if you see it, all resources, watch those yellow bar lines there. You see it's going up, hits about 2010, and then it just flattens off. And we see the same in copper. So if it's going up, and then 2010, it flattens off again. And it's not from want of trying. So if you look at 2010 where it flattened off, and then you look at this graph, and you can see the exploration expenditure has gone through the roof for gold, it's gone through the roof for copper. But it's not happening any faster. So if we look at this, is a great graph. It's the number of discoveries in Australia, significant discoveries from 75 to 2021. And you can see it's augmented by different trends in minerals. So you see from the 2000s up through to 2012, we've got iron ore playing a big part there. Always gold's played a part, and then some base metals. And then you'll see towards the end there, you've got your other, which is your battery minerals, basically. So you can see, even though expenditure rates are going through the roof, we're just not finding anything more. So the question that begs is, to Mike, with only a dozen or so significant finds per year, are the biggest hurdles geological, technical, financial? Have all the easy deposits been found? Like, are we flogging a dead horse? Like, are we throwing money at something that it's just too hard? Or do we need more money?
Yeah, I'd throw another filter into that, and that's probably jurisdiction. And I think obviously the developed economies and developed jurisdictions have more advanced filters or screening processes that you have to get through. And so companies as a whole, trying to spend the lower cost, have looked to take exploration risk where they can offshore. West Africa being a good example, Latin America in various phases and various jurisdictions. And I don't think there's a holistic, there's not a one shoe fits every foot there. It's very much dependent on the jurisdiction. So you can do shallow drilling, you can do soil anomalies, you can do shallow drilling, and you can find something in Côte d'Ivoire. Côte d'Ivoire has just relatively hasn't become more stable, it's become less unstable, whilst everything around it has hit. Mali's, Burkina Faso's been gone for a while, Mali's just about to go. You've got Guinea with various issues. So we're talking a prime sort of location of historic gold production, prime location for explorers to go, and it's cheap. And that all comes down to all-in sustaining costs. At the end of the day, going to what makes a mine economic, it becomes all-in sustaining costs. And West Africa, if you're shallow and you're oxide, you're sub 700, right? Well, there's no other jurisdictions that really can do that. Nevada by scale, and then you get onto what Jim was talking about in terms of scale. So it's really, and in Australia, it comes down to the state and how mature the exploration is, how deep you have to drill. I don't think there's necessarily an answer to that. Other than areas that obviously don't have in traditional landowners, indigenous population, dense communities, sensitive habitats, become easier exploration targets. And if they're stable or relatively stable or have become stable, then they become a sector for inflow. But I don't know. It's an open. I don't think there's a set answer for that. In my view.
Do you see that? Do we all think, and I don't know why, but for all these hardships, we haven't really seen the price go through the roof of commodities yet. Do we see that's coming? Will the market adjust for this? So will the price of copper go through the roof? Everyone's been predicting that for the last 3 or 4 years. Hasn't happened.
Well, copper's an interesting one. To me, it's probably the most important metal that we have. It's not seeing its value because when there are price rises, you've got huge capital investment in an average copper mine. Porphyry is the largest copper producers, a $5 billion, $10 billion sunk cost. They're going to keep pushing their grades from 0.4s to 0.38s to 0.35s to 0.3s, and the copper price is incremental to that. Yet the copper price, what we're seeing now, is a more forward look, a short bellwether curve on growth expectations and short-term growth expectations rather than really supply. And yes, there are big copper discoveries, and yes, they're coming, or developments, and yes, they're coming online, but we don't have a plethora of high-grade copper projects that are sitting there just waiting to be developed. The most recent one probably is Vicuña with BHP and Lundin, probably the best copper discovery, ignoring DRC, certainly in Latin America in the last sort of 10 years. That's now just starting to go into a development cycle in a country that's come out of 20 years of jurisdictional risk that no one was willing to spend too much money there, except for a junior Canadian who did the exploration when no one else was doing exploration in Argentina, and they were successful and they did it. So I think copper is an interesting one because it's dislocating supply. It's not like nickel, where nickel is a supply-demand equation. HPAL, no one thought lateritic nickel would ever work until the Chinese worked out how to do it in a jurisdiction where they could get away with environmental and social issues that in a lot of jurisdictions you wouldn't get away with permitting. Copper to me has that dislocation in terms of the supply demand curve.
So you don't see going through the roof? Like, you think there's enough low grade to expand?
There's too much installed capacity there already, and you've got all these. At the moment, Chinese refineries are actually paying to get people's concentrate. Now, albeit they're paying tiny amounts, but you're not, as a copper producer these days, you're not actually being charged to refine your concentrate, which doesn't happen too often. So
the follow-on question for that is, do we not need new deposits? Do you know what I mean? It's like, if we can just keep expanding out the grade on these bigger ones that are there, is there enough to get us through the population boom in the next 20 years?
No, and then you look at the growth, the 2% growth and the electrification and various models. The answer is no. Do the Escondidas, etc., keep producing to 0.15? Because at the end of the day, if you're putting in a 10 to 15 year development permitting cycle to then spend $10 to $15 billion to build a copper mine, you have to be pretty certain about that jurisdiction to do that. And there aren't too many jurisdictions in the world to jump out at you. And so your capital risk, allocation of that capital is pretty hard. And that, I think, is going to mean that the price is going to have to go up to keep the mines going, and incremental production, it'll be good if it happens, but maybe it isn't needed quite so much.
Okay, cool. Sue, the next question I have around this in declining discovery rates is the amount of compliance. Like, is compliance killing a lot of discoveries? What have you seen in your time walking juniors through the valley of death?
I don't like the valley of death. Like, my bread and butter is juniors, so I don't like the valley of death. I don't know. I think it's hard for them. I think, I'm WA based, and most of my work is from WA. So talking from WA, I think, all the easy deposits, the ones that people have tripped over, like the ones that surface have already been taken, like they've already been discovered, right? So now it's becoming geologically more complex for them to actually find it. So, like, people are finding them, but it's taking a lot longer to find them. So then we have the issue that, you know, people are running out of money, or the market's not wanting to invest in them because no longer is an exploration target exciting anymore. Like,
Yep.
it's too much risk for people. So, I don't, for compliance, I mean, it's hard. It's hard out there. The ESG is getting harder for them.
Yep.
And potentially with the new JORC code coming in, it could get harder. Or
In what way? So give us a couple of concrete examples of the JORC code making life harder for juniors specifically.
well, this is the original like 2025, 26 JORC code that got circulated, which has now gone back to. So originally, like for a junior to get a resource out, like even for me to get a resource out was going to get really difficult. Like I'm not an ESG specialist. We don't have ESG specialists. How are these juniors going to pay for all this ESG and all the other compliance that they're trying to put in and the modifying factors? Like, well, in my opinion, it felt like it was moving more from a resource into a reserve. So the resources were just going to disappear, basically.
Yep.
So it's going to cost juniors a hell of a lot more money to get to what they're getting to now. And I think it was just going to destroy them.
So you think, can the market sustain that? I think Rob had a great quote this morning when he was talking about, you know, these speculative investors have just got a short attention span. And so you're dragging that period across and they're just leaving in droves. And that's what causes the valley of death, basically. Is that what you're seeing? Like,
Yeah, well, the problem is it takes a lot more for people to get interested now. Like, as I said before, you can't just say, I've got an exploration target and everyone goes, oh, here's all the money. You're having to actually spend the time and strategically drill it out properly in order for these people to get excited about it. And sometimes that's just too long and you run out of money and then they go belly up. So it's just, it's hard for them, but, you know, I like to be positive, hence going back to historic projects.
Yep.
I mean, there are some easy wins out there. It's just people have to, how do I say it? I was going to say have the balls to actually go out
you
there.
can say that.
Well, they have to have the courage to go and say, you know what, this hasn't been drilled before because this terrain's terrible for a drill rig, but you know what, I'm going to try and make this work.
Yeah.
And some of it's paying off.
Great.
Coming back to your IPO thematic earlier, John, I mean, you know, when you lodge a prospectus, you've got to map out your exploration spend on your projects for a couple of years, right?
Yep.
So one of the things that people talk about with good exploration or how to be successful in exploration is you test your target, and if it's shit or a dog, you move on. But how does that line up with testing your target quickly in your IPO prospectus and your funding, and then people that have tipped or vended their projects into your IPO are escrowed for 2 years if it's, you know, non-arm's length type transaction? So, you know, there's a bit of contradiction there in, you know, what is deemed good exploration practice versus, you know, some of the framework that IPOs operate to, basically.
Yep. Cool. All right, moving on to the next question. And it's juniors versus majors. So, and roles in the discovery ecosystem. So if juniors are under threat, can majors fill the gap if juniors fade? So when I was researching this was the most interesting chart I had. So if you have a look at all the discoveries in Australia by company type, you can see that the juniors really, from 2000 onwards, have really taken up the bulk share of discoveries. So out of that chart, I think, it's 472 juniors out of 955, right? So if you look at the percentage share of expenditure, juniors only accounted for 45% of the total spend, but they accounted for 73% of all discoveries, which I think is an amazing statistic. I had no idea that they were that much better. So if you look at that in terms of what that is, I think it's about a 60% better success rate as a junior per dollar than a major. So if you give a major $1, they give you $1 back, you'll get $1.60 back off a junior, right? So that is just an amazing statistic to me. So if juniors are struggling, I'll ask Mike. So why do you think they do perform so much better than minors? And is there any lessons minors can learn from the juniors if they do disappear, I guess?
Yeah, I guess it's how to rub your penny the best way. It's really allocation and capital efficiency comes down to it. You've only got $100,000. What do? I can't blanket stream set. I then can't come back and do soils. I then can't go there. You have to go straight to the lowest cost, highest probability first pass, and then you've got sort of ballsy drilling as opposed to, right, we'll do a 20,000 meter program as my first pass. As a junior, you don't have 20,000 meters in your first pass more often than not. So I wouldn't say it's better. I wouldn't say it's better geoscience. It's probably more, I guess, risk on where you can be the most efficient and find and have the greatest chance of finding something. Majors also tend to be looking for the tier one assets. So they typically don't go in on regional scale, on a large scale, and look for that, whilst a junior would be happy with 200,000 ounces at 10 grams a tonne. So the model of what you're looking for is also slightly different. If you're junior, if you can get a tiger by the tail, then you're off to the races. But it's not always the case. And you look at how large companies do. Worked with Kinross and Rio and CRA, Phelps Dodge. You do things on a much bigger and on a proper level of scale than you can't get away with as a junior. You do things, you drill 5,000 meters, you have one geo, you have a local guy doing it, and you get away with stuff. The health and safety is, certainly if you're not in Australia, becomes a secondary thought as opposed to front and centre. So I certainly think, and the BHPs and Rios of the world hire the best graduates out of their programs, there's no question about that. But it's cheapest. How can I get a result to get the next financing or to get some treasury in? And for that, sometimes you have to be very selective as opposed to say, right, if I was going to do this from scratch, this is how I do it. And majors, that goes all the way through to their studies, the level of studies that they do, which is why they have big budgets and why they take a lot longer than a junior might do. So.
Is it also to do with the risk profile? Like we said from Sue, they've got bigger balls basically. So does that make it cheaper, in the long run? If you the higher the risk, you make something big, you've got more chance of success. So we're seeing that. Do you see that between the difference between a major and a junior?
Certainly the jurisdiction and cost basis. Where's the most expensive place to explore? WA and Nevada. Why? They're the most stable jurisdictions and more proactive in their mining thing. If you need to get results and you're going to look for low-hanging fruit, because juniors generally can't drill the 600-metre holes under an old pit or an 800-metre hole in an old pit off spec. But you can do shallow surface drilling or near surface drilling in higher risk jurisdictions. There are some changes. BHP's through their Explore program now in Kazakhstan and jurisdictions where people have ran out as fast as they could have 5-10 years ago, they're now coming back into. But generally, I think the risk appetite of those majors is, unless it's a very endowed jurisdiction, copper, is a great example, then they won't go into it. Barrick's got a huge risk exposure profile in Mali and Africa and all sorts of places. And you look at Newmont. Newmont's been shrinking out of that. There's a whole lot of examples. Chinese state companies and gold miners have taken filling that void of where these Western companies are sort of risk averse and moving out of the Africas and various places in the world. So that is another complex issue, and how you, as a junior, make that discovery, de-risk it, and then sell it. Maximize the value for shareholders is that process, discovery and then de-risking. And I don't know how, if you can't get money into the junior sector to make those discoveries, I really don't know how the next panel in 10 years' time is going to say, yeah, we've been doing this for 30 years and we've been successful at it. Because if you can't get the capital to do that sort of earlier stage exploration, then that's the challenge, I think, the biggest challenge that we have.
Yep, for sure. So, Andy, you've worked in both majors and juniors. Do you see that majors, they just got a bit lazy, they're just outsourcing it to juniors? And if that's the case, what happens if the junior model falters?
So, I mean, something that was said earlier, majors don't look for 100,000 ounces, which I think is what is the gold equivalent classification of a discovery.
Yep.
I don't know whether they're looking for 2 million or 5 million or 10 million ounces. I don't know, but it's probably unlikely to be 100,000 ounces. They're looking for not necessarily tier one. I think that word gets overused in our industry, but they're looking for something more substantial than that. So they're looking for bigger targets. I think, to avoid getting bogged down in small scale exploration, you've definitely seen the majors invigorate partnerships and alliances with juniors. I think BHP Explore, South 32 have got several going, and these are beyond just joint ventures, right? These are true alliances where you can use the often academic horsepower that's captured in the majors to assist with the exploration that the junior wouldn't necessarily tap into all the time. I mean, there's a consulting industry out there, like Snowden Optiro, etc., that can offer these services. So,
nice plug, Andy. Thank you for that.
I'm trying to get a few in.
Speak to Tarrant if you need any services, anyone.
Yeah. So, look, often majors have different geopolitical risk thresholds as well, and I think they're testing some of these jurisdictions through these alliances where they don't get full exposure. I think that's a healthy way to move forward. And then, if something is found, they'll just come and do the M&A piece and take out the junior.
Yep.
One thing with juniors and majors that I was thinking of earlier when Mike was speaking is exploration undercover. It's very hard for juniors to invest in that because juniors need news flow. If on this short-term mentality that you mentioned earlier about the markets, juniors are driven by the next quarterly release or the next exploration update. And, if I was an IPO going out to say, I'm going to take 2 years, I've got a great package of tenure, mineral systems analysis telling me it's fantastic, it's over lineaments, it's the right geology, you've got seismic profiles through it and everything. I'm going to take 2 years before I generate any results. The support for that from public markets would be a struggle.
Yeah, it's interesting now. It's drill results or nothing. You can't raise on a soil, you can't raise on a rock chip. It has to be drilled.
Yeah,
ground,
and
right?
with the boom bust of the industry, it's got to be gold drill results right now.
Yep. Yeah, that's right.
It can't be nickel or lithium.
Yep. And speaking of that and changing that commodity, right? So this was the last one on that juniors versus majors. So if you look at this is gold EBIT. I mean, we're in the wrong business in software, we've got to say, because gold's going 60% EBIT. It's quite amazing. So yeah, but we're not really seeing that convert into R&D in the majors. That's you'd think like, okay, they'd be putting a lot more into it, but they're still resting off the juniors, probably because they can. So the next question I have is around commodity trends and pivoting focus. So we saw 2 years ago, it was lithium, lithium, lithium. Now it's gold, gold, gold. So if we have a look at expenditure, and you can see, so gold's gone up. But if you see like uranium, mostly the miners there, that green, it went right up into 22 and now it's dipping down into 24. This is a much better chart and shows just how quickly things can dry up in a commodity. So if you look at, it was lithium from December 23, there was 800 million invested down to zero by March 24, right? So it just waxes and wanes pretty quickly. So as juniors, you know, is that change of focus, especially it takes 10, 20 years to get a mine up, you know, the fluctuations go, but they're just running to the next coolest thing to raise money. Is that detrimental to finding anything basically? So is chasing the latest commodity, is it a distraction or a lifeline? Jim?
Yeah. So again, the timelines don't marry up anymore because in the good old days, you get a commodity boom and then you go and option a project or peg some ground or whatever, get some rock chips, and then you go and raise the money and, you know, drill it, et cetera, and off you go to the races. Now, because of the timelines of land access here, they don't equate to that commodity cycle timeline, and the commodity cycle timeline seems to have speeded up. I mean, that lithium boom, you kind of blinked and missed it, you know?
Yeah.
So the ability that you could get on the ground, you could get all the clearances, you could do the prospecting, you could do all the environmental stuff, go and drill it, find something, then go and raise some more money. By the time you go and raise some more money, it's gone. And so you're in the valley of death before you've even found anything. you know, I mean, it's a different valley of death, you know? So, you know, you add on to that the complexities of what's happening overseas as well. And I just, you know, relating to the last thing, I just wanted to relate what's happening in WA and these sort of issues. We're talking about WA partly because we're here, but a lot of these things are informed about what's going on in Africa and with the Chinese. You say, oh, you know, is it the death of the junior and everything else? When you're a junior miner, you've got the option of where to go and where to find a project. And this is something I think about every day because I'm in that position. And you go, well, I could run over to Africa, and we were saying here, my friend was saying here, you know, you go into a country like Mali and I know this guy that runs a security company in Mali. He was in my battalion in the army actually. And he's the last guy left in Mali running a security company, quite a guy actually. But yeah, you go in there, that's great. You do a deal, you try and fend off all the nightmares that Resolute have had to deal with, et cetera, whatever. Then you come out. Well, chances are, if you've done a deal in Mali, chances are that you will be looked at by governmental organisations as potentially having given a bribe, and you may well have done so to get to that point. So you're then up against potential legislation that could put you in jail. I think it's 7 years for if you are doing foreign undertaking some endeavour of foreign bribery. Then if you're British citizens like me and Andy, you get out of jail after 7 years, and then the Brits pick you up, you get another 7 years. So, you know, what are we meant to compete with the Chinese?
See, you thought this through, Jim.
You know, I had an interesting experience in India when this exact scenario, you know, as I thought I was about to inherit this wonderful phosphate deal, and then on it came the bagman, put the hard word on me, and it was like, okay, so you know, and that it all unfolded. I thought, all right, okay, been a bit naive here. So, although I was waiting for it, but you know, how on earth can we compete with the Chinese in these scenarios? When they're going into Africa, they don't care about health and safety largely. They do here. They run some good companies here. But in Africa, pretty much it's left to the locals. They're going in there with an infinite amount of capital. All they care about is getting their raw product out. They control all of the smelting chains, not only for obviously copper, as was mentioned, but for lithium and everything else. But also, I mean, the rare earth, they are virtually the only people who can produce the different elemental rare earths that are have to be produced. I mean, you cannot compete with that behemoth. It's frightening enough when you're looking at it from the point of view of humble mineral exploration guys running mineral exploration companies. Imagine when you're looking at it from the perspective of national security, it's downright terrifying. And well, we've got to look at all of these issues. When the gentleman from the environmental spoke, and obviously I asked him about the RAAF problems with it. But all of these things have to be looked at from a higher level, because our national security is being very seriously compromised by how the minerals and exploration, and particularly the petroleum sectors in this country, are headed. And if we don't address some of those issues, then this panel in 10 years' time might be wearing green, you know?
All right, so we'll keep moving on. And this is the elephant in the room, I would say, and it's the one that causes the most emotion, and it's about regulatory, ESG and land access challenges. Is it getting harder for juniors to explore? Do we have that level of sophistication to be able to deal with these new problems? So if we have a look at, this is a report on investment deterrence from CEOs from the Fraser Institute, and you can see 65% of people, the highest ranking subject was uncertainty over which areas will be protected, disputed land, regulatory duplication and inconsistency. So nearly all the main concerns were about access and regulation. So Jim, I know you're quite passionate about this topic. How have you seen it change since when you were first operating back in the noughties?
Well, the change is total and absolute. Back in the, good old bad old days, 1990, 1992, when I was in Meekatharra working for Ross Atkins with St. Barbara Mines. Back then, Ross would just jump on his bulldozer and go, I've got to open the country up a bit, and just head for the hills with that D9, There were no regulations, and I'm not saying that's a good thing necessarily, but it did work, and a lot of mines were found, whole areas were reopened up and developments made, industries were built. Now, if you put the boot on the other foot, industries are closing down just as fast. And I'm not talking about, restaurants. I'm talking about primary industries. We've just lost the live sheep trade. We've basically lost the nickel industry. There's nothing left of that. There's virtually no copper mining in this state. I don't think there's any now. I don't think there's any anymore. And what other ones, have we lost in terms of the rural? You drive out through the wheat belt. You go out to Edudina Station, out in the far east of the east 200 k's east of Cal. That used to have 30. I was there last week doing a heritage clearance survey. That used to have 36,000 sheep on one station. Okay, when Neville Shute was writing his books in the 1950s, the world lived off the sheep's back, off mainly, well, to a large degree, off West Australian wool. There is no wool industry anymore, and that was a primary industry that's completely gone. There are others that I can't, lithium's effectively gone. Okay, so industry after primary industry is getting kicked out the door, and when the iron ore industry finally returns to $35 a tonne, which is its historical norm, if you look at the timelines that I've been talking about today, then the party's over and all hell is going to break loose for our economy, for our balance of payments. And if you think the bond market differential for long-term bonds of the US versus gold looks interesting, as Shippo mentioned at the start, now you wait and have a look at our long-term bond repayments when the price of iron ore reverts back to $35 a tonne. Or this country will be in a state of absolute economic hell. And that could be as close as tomorrow. And it's all down to the iron ore industry. And it's because we've thrown our primary industries under the bus. And we've chosen to do it through land access, land tenure, environmental, and all of those things which have a place. But they have been so overdone, so over-egged, that we don't realise that in terms of getting the balance, that balance has been paid for in terms of doing over those primary industries we should have nurtured. It's been paid for and subsidised by an orgy of iron ore money, which is going to end. History tells us it has to. So that's my happy, sunny little message for the party tonight.
So just to keep going with that, Pete, you deal with these issues a lot. What have you seen in the last 10, 15 years? What law would you say is the one that's holding up exploration the most? And is it a fair law? Is it right to be in place, or should it be removed, or is there a better way to do it?
Yeah, it's a combination of laws, not just the one law. As Jim was saying, we're just going for the regulatory hurdle from Commonwealth, from states, from shires. Like the Shire of Coolgardie put up their rates for the mines 100%, and that was blocked by the minister, thank God. But everyone thinks the mining industry is a bucket of money, so everyone's going for the money. You know, from the Aboriginals to the Environmental Defenders Office, the EPA. They just putting all this regulatory hurdles in front of us. So it's just accumulating to. That's why the juniors can't get on the ground.
So it's not one in particular. Is it a death by 1,000 cuts in a way? Like it's a total.
Yeah, it's a
perfect storm.
You said the word there. It's a death by 1,000 cuts, and until they appreciate that, take a step back and think. You know, we need to do something about this. I don't think we're going to see a complete rollback to the days of 92 in Meekatharra.
But that's a good thing as well, right? I've got to acknowledge that. There's a lot of good comes out of these laws as well. It's not just...
Yeah. But the wool industry absolutely destroyed the Gascoyne. I mean, you go up there now and there's no plants. There's nothing. It's there's a few shrubs and that's about it. Yeah, even the salt bush has been eaten to a bloody skerrick of what it was. And you know those salt bushes take years and years to grow. And the primary industry is dying by the same way. You know, you can't clear anymore. Absolutely can't put your finger on a piece of grass these days without getting hauled over the coals for it.
So where do you see the balance is between exploration, you know, primary industry success and conservation in a way?
Where do I see the balance?
Yeah.
Oh.
So, you know, you're saying it's gone too far one way, or so, you know, where's that sweet spot?
There's been a lot of exploration out there, and there's a lot of tracks all over the place out there. And there's no reason why, and we can track by satellite these days if anyone's doing anything wrong. The Landgate actually do flyovers over the complete state every year. So if you're doing anything wrong or destroying the environment, you can get pinged for it. Get artificial intelligence in there, cross-referencing. You know you're dead. So there's no need for all this regulation that they've introduced. You don't need to submit another POW to tell them what you're going to do because you're reporting it in your annual reports, and it's getting monitored from the sky. Yeah, I mean, it seems useless pieces of legislation. Yeah.
Gotcha. Is Gary Middle still here?
No, it's shot through.
All right,
Yeah.
cool.
All
right.
right, just one quick one on that. But please be aware too that for each regulation that comes in, that's one regulation comes in, that's one times harder. When you put another one with that, it's not 2 times harder, it's 4 times harder. It's logarithmic. So by the time you add like 20 of these things, the thing's just through the roof and it becomes impossible. And that's the state that we're at now for the scale of deposit that we were talking about earlier. You just can't find them, drill them, develop them. So we've cut out a huge, massive portion of the state's prospectivity through all of this duplication that I think Peter's trying to get to. The whole thing needs to be simplified because there is too much red tape, which is compounding the red tape.
Yeah. And Nature Positive, which Gary was talking about before, we're actually, I hate to admit it, but we were saved by the Labor Party in talking the Labor Party out of introducing it into WA. If that gets in the door, we're pretty much stuffed. Yeah, you'll never get another mine off the ground if that gets in the door. It's flat out getting one off up in New South Wales at the moment. Yeah.
All right, so it sounds like it's a pretty grim picture. So in terms of exit strategies, in terms of mergers, acquisitions, or extinction, so just the panel, where do we see it going? What's the best end result for a junior? Where do you see, will all these M&A at the moment, will they all join up, or you've got all these zombie companies hanging around? What's going to happen to them?
I'll kick it off. If I had $10 million or let's say $15 million in an exploration company tomorrow, and hopefully I will have in a few months, I think, all right? If I had $15 million in an exploration company that I controlled, I'd hold a shareholders meeting and return that money to shareholders and wind the company up. That's how bad it is.
Mike?
Yeah.
Jesus, look at that. Go home and...
Yeah, I don't know. I recently went through a process of talking to a whole lot of zombie companies on TSXV, saying, listen, there's capital in Australia, there's no capital in Canada. Let's talk your project. You can get exposure to ASX, you can get money, whatever. And 98% of them, their response was, no, we think our asset's worth 30 million. We'll prefer to stay zombie delisted, sort of in cease trade order, and stay there because they believe in they've had a couple of high net worths who are happy just to sit on that asset and wait for it. So I think there'll always be little sort of pockets of resistance, but certainly consolidation. You're seeing now groups who are tying up assets that give them some diversification. You touched on the sort of the move of companies to sugar rushes. Is it a distraction or is it evaluating? If you're a CEO and you need to raise money because you've got less than $1 million in the kitty, if you don't have an antimony project that you can jump to or a tungsten project that you can jump to, then you're in a between a rock and a hard place. If your project's a niobium or a tantalanium project, you're sitting there going, well, the only chance I've got to do for this to work is I have to be in the 25% cost quartile, I have to have infrastructure, and there has to be an end market for my product. If you're a rare earths, which is the current second flavour behind gold, as Jim mentioned, all that technology is in China at the moment. And so as much as we talk about it, whatever, until that technology comes out, or is Mountain Pass in the US are trying to build the technology. I know Linus are trying to build the technology, but there's that final separation, and then there's all that downstream. And if you don't have any of the downstream and the bottleneck is the processing, then those rare earths are great option plays. Are they going to fundamentally create value? And if you can't sell them to the Chinese, who are you going to sell them to? So I think there's a whole lot of things here at play in what we do and what everyone in this room does in terms of how do you keep the lights on? How do you how do you keep doing exploration? If you've got $2 million, if you have to spend $500,000 and 7 months doing the various surveys and the various things, your shareholders aren't going to take that. Take Jim's point. You're going to have to give the money back to them, which means there has to be some shrinking of the number of companies listed. It has to be because they cost money. So I don't know how and where that goes. The cycle is interesting. You can generally pick the end of a cycle based on the M&A activity. We've seen all this gold M&A.
Wasn't it a taxi driver giving you share tips? Wasn't that the other one?
Rio have done a great job just recently doing a whole lot of lithium acquisitions in the trough. Like that's the Corp Dev playbook, is you acquire in the You become contrarian, and you pick up stocks or commodities that are out of flavour and at low cost, and pick them up. Now they had to pay premium dollar for them, but that's the sort of forward-looking that the majors who are into it can pull off, and they're playing catch up because geopolitically the Chinese have been doing that in Africa and various places for the last 30 years, and now Western countries are just realising, hold it, resource security, supply line logistics, etc. There's a whole lot of issues there, and it'll be very interesting to see what happens in the next 5-10 years and how that geopolitical supply security, technology, funding works out in a commodity price cycle that doesn't allow exploration, development, and then construction. So I think there's a whole lot of things that everyone in this room is going to be faced with, and I don't think there's an answer for any of it, but it's certainly challenging.
Yep. And Andy, Mr. WA M&A.
Well, I think following on from your last thematic, the barriers to entry in this industry for junior small end companies has increased. It's not getting any less, that's for sure. So that supports, some of the data you're showing that there's all these zombie companies, and one way around that is critical mass. But often in these smaller end of companies, there's egos at play that prevent any sort of logical consolidation, and that's why you'd be probably forever, in my opinion, stuck with that issue. But raising $12 million or $15 million that Jim mentioned before, if he had that in the bag,
would you give it back, Andy?
no.
That's good to hear.
No, I could, because that's my job, is to turn that into 150.
Yeah. But do you still think you can do it? It's one thing to say you can do it, but do you have the personal belief that with 15 mil you could make 150?
Of course. And touching on Mike's point, he touched on Rio, very deep pockets, counter-cyclical investment. There's plenty of ultra high net worth individuals in Australia that do the same as well. Someone like Mark Creasy, who sits there, he won't be chasing the next fad. He'll be positioning himself for the next cycle. So some juniors can do that with support of ultra high net worth like that.
Yep.
Most of them have to follow the latest craze, unfortunately.
So if you've got the right partnership, you're going to be okay.
Yeah.
That's what you're saying.
And that critical mass is really important. If you move from an explorer to a producer, then institutional money will come in onto your register. And, the Australian superannuation industry is over $4 trillion in that. Your superannuation is going up to 12% next month. It's growing like that pool of money, but less than 40% of it's invested in Australian equities. So you need that critical mass to attract that investment, because they won't touch the small end of town.
Yep. And tying back some of the stuff, Fauna's presentation on the basin depth and the reinterpretation of that in WA, there's a huge opportunity there to say, right, let's peg all that land around the new sort of shallowing basin rim, look for a broken hill type deposit, blah, blah, blah. I was recently in a company that was doing that. We had that sort of land from 3 years ago, it was put into an IPO. There was an EIS sponsored drill hole. It hit 2 meters at 1% zinc. Company's out of money. That's sort of gone. If there's not money in the market to fund IPOs to go out and look at that project generative type large scale work, then that's left up to the majors. And that's where the gaps start falling, because they can't cover everything. So those incentives and stuff are working, but they run into a headwind. And if you don't have boots on the ground, and you can only get boots on the ground if it's funded, then there's going to be big gaps opening up, which creates opportunity. And everything, a gap is an opportunity. At someday in the current market, there's not the financing available to go out and chase greenfield conceptual that may require 100, 500 metre deep holes.
I don't think there is. There has been though, right? It's
the concept's always, you can get flavour. You need to be in the right commodity. I would say that zinc and lead is certainly not the right commodity to get that flavour at the money. If you could find some copper in with it or some silver, then maybe that's a bit of a lining on the cloud, but it's very, very hard on that market.
If I could summarise perhaps a couple of those points, the opportunities here, or the opportunity here is shifted from greenfields to brownfields, and from small companies to bigger companies. That's as I read it.
Yep.
Yeah, and certainly most of the exploration in Australia is brownfields, either historic walking, like well and truly historic walking. People have walked away when commodity prices have hit the floor, and now obviously gold's back. That's supporting a whole lot of other things. Copper's obviously back, but there's not much greenfield exploration.
Yeah.
So just with that, one comment about that for the juniors. Just, brownfields, I see that as exploration in the shadow of the headframe kind of exploration.
Yep.
If you go looking for lithium in tenure that's been locked up by a gold producer for 30 years, even though it's in the middle of the eastern goldfields, to me that's greenfields exploration, or looking for a new search base. So we want to move away from flogging a dead horse doing the same kind of exploration that's been done for 20 years in the same place, but there's still opportunity for juniors if they're nimble enough to make success in.
And that's pretty much what we saw with lithium, right?
Yeah.
That was a great example. People knew, tin mine, must be lithium, let's go for it.
Yes.
And, good 10 companies made a lot of money out of it. All right, that's all.
I want to say something.
Sue? Sorry, Sue, I didn't see you there.
Clearly have a very different background to these gentlemen here. I'm maybe naively very optimistic because all of my clients are juniors, and I actually think you guys have very valid points, and it's probably true, and I'm probably hiding under a rock because I don't want it to be true. But I've got clients that are multi-commodity, so they're shifting from lithium to gold to lithium, niobium to copper, copper to niobium. They're diversifying to make it so they can survive. So I'm actually quite optimistic. After this panel, I'm not as optimistic.
Sorry, Sue.
But for me, I think there's opportunities out there, but like I've said before, you have to be strategic.
Yep.
And look at it a different way. We can't keep looking at, as you said, the same way. We have to look at it from a different way.
All right, thank you for your time. I'd really like to thank the panel, especially. Some great opinions there, great conversations.